Understanding restatements, importance, implications, and requirements. A restatement involves revising one or more of a company's previous financial statements to rectify an error. While such assertions can stem from several causes, including clerical mistakes, miscalculations, or even instances of fraud, the need for accuracy in financial reporting cannot be overstated. This article delves into the concept of restatements, the processes involved, and the significant effects they can have on a company's financial reputation. Key takeaways. A restatement occurs when inaccuracies in past financial statements necessitate corrections. Accountants play a crucial role in determining whether an error is material, that is, significant enough to warrant a restatement. Errors are considered material if they impact financial conclusions drawn by stakeholders. The Financial Accounting Standards Board, FASB, mandates restatement when errors are identified. Reclassification only involves correcting the classification of an entry without necessitating the issuance of a new statement. Understanding restatements. Financial statements, such as balance sheets and income statements, are essential for current and potential investors, regulatory bodies like the Securities and Exchange Commission, SEC, and company stakeholders. The primary goal of these financial documents is to present a clear and accurate picture of a company's financial status. Therefore, when inaccuracies are identified, the responsibility falls upon company management and independent auditors to initiate a restatement. The process for assessing whether an error warrants restatement generally requires the application of judgment. Accountants evaluate whether the misstatement could mislead users of the financial statements, which may lead to poor investment decisions, regulatory penalties, or diminished market confidence. Material inaccuracies. Materiality, albeit a somewhat subjective standard, serves as the threshold for determining the necessity of a restatement. According to the FASB guidelines, a misstatement is deemed material if it could influence the economic decisions made by the users of the financial statements. For example, if a company underreports its tax liabilities, shareholders may be led to believe they are receiving higher profits than actual, potentially triggering misguided investment decisions. Types of restatements. 1. Error correction. This involves correcting past errors due to incorrect accounting practices or mistakes in calculations. 2. Fraudulent misrepresentation, more severe and damaging. These restatements arise from intentional deception or fraudulent reporting of financial outcomes. They raise significant ethical concerns and can prompt regulatory investigations. 3. Reclassification. When errors stem from misclassifications, the adjustment distinguishes it from a full restatement. For example, if an asset is misclassified as a current asset instead of a long-term asset, it does not require complete reissuance of financials. Dangers of restatements. While many restatements may originate from innocent errors, the implications for a company can be dire. Negative restatements can devastate investor confidence, lead to declining share prices, and signify a lack of governance or oversight. Companies may face not only reputational damage but also tangible penalties. For instance, Hertz Global Holdings Incorporated had to pay a hefty $16 million civil penalty due to inaccurate financial reporting. The dangers extend to market norms. Repeated restatements can dampen investors' willingness to engage with a company's stock, fearing future inaccuracies. This phenomenon illustrates that trust is essential in the realm of investing, and restatements can severely undermine this trust. Case study: Molson Coors Brewing. In February 2019, Molson Coors Brewing Company announced the need to restate financial statements for fiscal years 2016 and 2017 after discovering accounting errors related to deferred tax liabilities. The company revealed that due to mistakes following its acquisition of Miller Coors, net profits were inflated by nearly $400 million, leading to significant corrections on their financials. This incident exemplified how errors can undermine shareholder confidence and impact a company's market valuation negatively. Restatement procedures. When a public company identifies the need for a restatement, it must follow regulatory protocols. 1. Filing SEC Form 8K. This form must be submitted within 4 days to notify investors of the inaccuracies in previous financial statements. 2. Amendments to financial reports, amended quarterly, 10Q, and annual, 10K, forms need to be filed for the affected reporting periods along with corrections. 3. Disclosure of error investigation. Companies are usually required to provide footnotes detailing how the error occurred, the impact of the correction, and company plans for preventing future errors. Investor considerations. Investors should be vigilant when restatements are announced. Key questions include: what was the nature of the error, and how did it occur? What measures will management implement to prevent recurrence? Does the timing or scale of the restatement seem excessive, warranting further investigation into potential fraudulent activities? Financial estimates. It's crucial to recognize that not all changes in financial estimates necessitate restatements. Adjustments related to future expectations, such as anticipated liabilities, are typically recorded in the next financial statement, rather than requiring retroactive corrections. Bottom line. Financial restatements are essential for maintaining the integrity of financial reporting and protecting investor interests. Though often arising from innocent mistakes, these corrections can carry serious consequences for management and shareholder trust. It is paramount for companies to address inaccuracies promptly, transparently, and effectively to sustain confidence within the investment community. Stakeholders must stay informed and alert to the ramifications of restatements to make educated decisions regarding their investments.